Uh, Hello everyone, my name is Muhammad Fajar Nugraha from Fiscal Policy Agency Indonesia. So on this occasion, I'm going to deliver my research on the US monetary policy impact to the Indonesian government bond yield. So there are four subsections that I'm going to present from introduction to deliver the research background. And then we are going to discuss the financial integration and financial contagion theory, as well as the global economic transmission as the theoretical background in constructing this paper. So to estimate the impact of the US monetary policy and its volatility to government bond yield, I use GARCH method, which I will deliver it in the methodology section. And we will discuss my research results that the US monetary policy has significant influence to the Indonesian government yield. Uh, so the increasingly integrated global financial market not only brings benefits, but also carries risk. The integrated financial market opens wide door for investors to diversify their portfolios, and in various countries, it'll also expand opportunities for them to invest more efficiently. This situation can facilitate the government to seek financing from another country to the bonds issuance. But on the other hand, integrated financial markets can be a problem when economic shocks from one country, especially in developed countries, spreading and weaken the economy of other countries, especially the developing countries. Based on this phenomenon, the study intends to examine the influence of the United States monetary policy as an external shock factor on the Indonesian government bond yield before, during, and after the quantitative easing. The ability to analyze the behavior of the Indonesian government bond yields to an external shock in a globally integrated financial system will be a precious instrument for the policymakers, which will help the policymakers to be better prepared in facing external financial shocks in the future. So the study limits the scope of global economic events that affect the yields of Indonesian government bond yield, the change in U.S. monetary policy. So to see the influence of U.S. monetary policy, the study has arranged periods from January 2004, before the Fed fund rate entered the zero lower bound condition, to December 2008, after the Fed fund rate being normalized. The period is divided into three subperiods before quantitative easing, during quantitative easing, and after quantitative easing. This was done to find out whether there were differences in the impact of US monetary policy during the study period, and especially to determine the impact of the normalization of the Fed fund rate on the Indonesian government bond yield and compare them with the previous period. So there are several definitions to define the financial integration. For instance, American Development Bank define financial market integration as the process which a country's financial markets become increasingly integrated with other countries or globally. On the other hand, financial market integration also can be defined as a process of two or more countries or regional markets becoming more interconnected. Financial integration can be achieved in two ways. First, formal efforts that arise from the agreement of two or more countries. For instance, eliminating regulations or tax. And the second one is the integration can arise without explicit agreement between two countries, such as foreign securities trading, or foreign banks enter the domestic market, or direct loans to domestic companies from the international loan market. An integrated global financial market allows investors to move funds from one country to another. And Levin shows that financial integration helps strengthen the domestic financial sector, which enables more efficient capital allocation and greater investment and growth opportunities. On the other hand, financial integration also has risks of aggravating the financial contagion if a country experiences a crisis or change its fiscal or monetary policy stance. On the other hand, we can define financial contagion as the spread of market disruptions or vulnerability of one country from economic events that occur in other countries. Kaminsky coined the term contagion trading strategy as the sale of or purchase of a financial asset in one country when the financial markets of that country have increased or decreased. For instance, the contagion phenomenon can exist if there is a suggestion whether investors buy or sell financial assets in one market based on economic and financial conditions, and based on financial and economic conditions in other countries. So according to Abeke and Kyobe in 2015, there are 3 channels for global shocks that can have an impact on developing countries' financial assets, including the government bonds. Those channels are liquidity channel and portfolio balance channel and confidence channels. First, liquidity channel is captured through the US 3-month T-bill rate. So for example, the normalization of the US financial condition can trigger an increase in the level of short-term US interest rates, which will reduce global liquidity. And the second one, portfolio balance channel, is captured through the US 10-year Treasury bond rate. The indicator captures the transmission of the Fed's of the US Fed's policies that can increase the long-term yield so that it affects portfolio rebalancing against risk assets in developing countries. And last, the confidence market indicators are captured through the volatility index. This indicator captures market sentiment in investing against risk. I'm sorry. This indicator captures a market sentiment in investing in risk assets. So the volatility index can increase because there are uncertainties that occur when the normalizations of the developed countries' monetary policies can change asset prices in developing countries because of the uncertainties. So according to Forbes and Regression in 2002, there are 4 approaches to measure how an economic shock that can have a global economic impact, such as cross-market correlation coefficients, GARCH models, core integration techniques, and direct estimation of specific transmission mechanism. This research model was built using the GARCH method to measure the impact of the US monetary policy on the Indonesian government bond yields. This GARCH method is possible to see the impact of monetary policy on bond yields and its volatility during the study period, because volatility is one of the important determinants of asset values for stocks and bonds. Therefore, the study used the GARCH method as the methodology that can capture the volatility of data. Moreover, the time series of data of the government bond yield in Indonesia is very volatile, which causes the assumption of constant error variance to be violated, making the OLS models becomes kind of problematic. So Forbes and Regression further emphasize that the existence of heteroscedasticity result in the bias test results when using the correlation coefficient approach or the OLS. So on the other hand, GARCH use heteroscedasticity conditions and capture a variety of persistence and time to model of financial assets, including bond yields. The GARCH model is divided into mean equation and variance equation. The main equation is used to see the significant effect of external shocks, in this case, the US monetary policy. This is needed to see the difference in impact before the Fed fund rate normalization, before the global financial crisis occurred, and before the tapering tantrum occurred. So if you look at the equations, as I mentioned before on the previous slide, there are several channels to capture the impact of changes in the US monetary policy. First of all, this model capture the portfolio balance channel that is captured by the US 10-year Treasury bond rate. And the second one is captured through the confidence channel through the volatility index. On the other hand, this research also used the variance equation to see the bond yield volatility from persistent parameters on the GARCH variance equation. The persistent parameter obtained from the sum of the beta 1 and beta 2 of GARCH model. If we combine the sum of the beta 1 of beta and beta 2 of the GARCH model, and the value is near 1, close to 1, it implies that the financial assets experience continuous volatility. Sorry. Okay. So it all began when the Fed announces. We can see from the graph that the Fed at the FOMC meeting reduced its benchmark interest rate, the Fed fund rate, to zero lower bound condition at the height of global financial crisis in 2008. So this kind of situation also pushed the Fed to implement the quantitative easing policy from 2008 to 2012 to stimulate the economy to recover from the crisis. The quantitative easing also contributes to capital inflows to emerging markets. Lim and Park found that capital inflows in developing countries during the quantitative easing period were more significant before the global financial crisis period. And there were concerns if whether there is a negative impact of the US monetary policy emerged when there was a reversal of the quantitative easing policy. So it actually happened when the Federal Reserve announced to stop its monetary stimulus. The quantitative easing created a phenomenon called the tapering off or tapering tantrum, which became a negative sentiment for the developing countries' financial market. So after several delays in increasing the Fed fund rate, the Federal Reserve finally increased the rate by 25 bips to 0.5% on the 16th December 2015, and then as illustrated in the figure, the Fed again increased benchmark interest rate steadily to 2.5% at the end of the December of 2008. As the government bond market started to develop, there are also increase in foreign ownership in the Indonesian government bond market. So foreign investor ownership in the Indonesian government bonds is increased exponentially from 2002. It's only 0.48% to 2008. It almost reached 39%. So there is also an implication from this situation. So high participation of foreign investors could amplify the impact of global economic shocks. This was proved by Ebeke and Kyobe in 2015 that found that the high participation of foreign investors in the domestic bond market, especially when reaching the 30% limit, could amplify the impact of the global economic shocks. Indonesia experienced the largest daily increase of the bond yields, about 403 bips in October 2008, when there were external shocks from the US financial market. Of course, there were global financial crisis at the time. Also, and the yields also increased when uh, when finally the Federal Reserve shut down its quantitative easing policy, and when the Fed normalized its Fed fund rate. Okay, so before I explain the regression results, I want to explain about the descriptive statistics. From January 2004 to December 2008, it can be seen that the 10-year government bond yield has experienced its maximum value in 2008, which reached about which reached about 20.95%. Yeah, which reached 20.95% that occurred in October 2008. And then the kurtosis value of the 10-year government bond yield is slightly greater than 3, which means that the data has a sharp shocks or has tachycardic condition. To conduct the stationarity test, the study used the ADF test to check whether the data is stationary or not. So as I use the ADF test, it shows that all data are not stationary at the level with a significance of 1%. So I use the first difference to make the data stationary. So then before doing the regression using the GARCH method, this study has to identify whether the variables are having a heteroscedasticity or not. So this study used white test to identify the heteroscedasticity in all variables. Based on the white test results, all variables are having heteroscedasticity. So the study can use GARCH to treat the heteroscedasticity condition. Based from the GARCH estimation results during the whole period, 2004 to 2008, in the long run, the US 10-year yield and the volatility index that measures the portfolio balance channel and confidence channel has significant impact to Indonesian government bond yield. The coefficient sign of the US 10-year yield has a positive value with a significant level of 1%. While the volatility index also affects the Indonesian government bond yield with a significant level at 1% also. So it can be concluded that the regression results prove that in the long run, U.S. monetary policy influence Indonesian government bond yield through portfolio balance channel and confidence channel. Those results are in line with Abeke and Kyobe in 2015, which states that U.S. monetary policy shock that raise or decrease the U.S. government bond yields will be directly proportional to an increase or decrease in the yields of developing country bonds. So during this long run period, government bond yields experience constant volatility. The the sum of the variance equations is reached nearly 1. This means that throughout the entire study period, the Indonesian government bond yield experienced continuous volatility. The high volatility of Indonesian government bond yield on this situation in this period occurred because there were several global economic shocks, such as the global financial crisis, of course, the taper tantrum, and the normalization of the Fed fund rate. Before the quantitative easing period, the U.S. 10-year yield also has a positive coefficient impact with a significant level at 1%. The volatility index also has significant influence to the Indonesian government bond yield. And during this period, the influence of the volatility index is strongest compared to other periods. This is partly because in this period, the global financial crisis occurred. And then during the quantitative easing period, the U.S. monetary policy that captured to the U.S. 10-year yield and the volatility index also has positive and significant influence to Indonesian government bond yield. The GARCH of variance value during this period is not volatile as the other. Is not as volatile as the other periods. Meanwhile, after the quantitative easing ended and the Federal Reserve normalized its Fed fund rate, the U.S. 10-year yield experienced an increase in influence to the Indonesian government bond yield. The effect of the U.S. Of the U.S. monetary policy through portfolio balance channel in this period is the strongest. Is the highest compared to other periods. This happened when the Fed stopped its quantitative easing policy and began normalizing its Fed fund rate. So the U.S. monetary policy through portfolio balance channel also shows increased volatility during this period compared to previous quantitative easing periods. So this is in line with research from GARCH and Fajar that said that there was an increase in volatility that peaked in developing capital markets during the tapering off period. So the GARCH regression results in this study show that U.S. monetary policy through portfolio balance channel and confidence channel affects the yields of the Indonesian government bonds with a positive coefficient. So an increase in the benchmark interest rate in the U.S. can be transmitted to developing countries, especially in Indonesia, by putting pressure on the on the financial markets to conduct to a higher interest rate. This implication can limit the scope of the Indonesian monetary policy to drive economic growth, and also it will create difficulties for the government of Indonesia to get financing, especially to issue the bonds in global market. So because of this situation, can push the government to increase its bond yields, and the increase in bond yields resulted in the high cost of financing in our annual budget. So this research suggests 3 policy alternatives that can be done to overcome the impact of normalization of the Fed fund rate. First, policymakers should encourage the development of the Indonesian bond market and diversify investors in the Indonesian bond market. For instance, encourage the financial institutions, particularly insurance and pension fund, to invest in the Indonesian bond market more, develop financial instruments to attract retail investors also may help. So a significant presence of the insurance industries, pension fund, and retail investors can help the Indonesian government bond market to diversify its investors and reduce foreign ownership in the Indonesian government bond market, which can lead to less volatile in government bond. Second one is implement some measures of capital management. So Brunei and Shin study in 2014 shows that managing excess capital flows is essential to create economic security. Shin's research also said that the preemptive action to manage excessive capital flows is essential in maintaining economic resilience on the external shocks. Khatib Basri, also recommends various capital management policy that can be taken to anticipate the normalization of the Fed fund rate. First, maybe the alternative is that implement the Tobin tax, or maybe perhaps the reverse Tobin tax policy to minimize the negative impact of short-term capital inflows in the future. And the second one, capital inflows that originating from the FDI can be channeled to export-oriented sectors, which is necessary to minimize the risk of currency mismatch and pressure on Indonesia's balance of payments. Another important thing that can be considered by the policymaker is, of course, the policy coordination and effective communication to public to reduce the negative sentiment and negative expectation of the investor and markets. So what needs to be done is to improve the coordination and communication so that it can run effectively and anticipatively in dealing with global economic shocks, such as maybe perhaps a normalization of the Fed fund rate in the future. Clear communication can provide confidence for investors and the public to prevent massive capital outflows from leaving Indonesia in a short time. I think that's all from me. The presentations of my research. Thank you for attention, everyone. And if you have any question to discuss, feel free to contact me through email. Thank you, everyone.